Hey everyone, welcome back to the new lesson, which is going to be advanced level ICT concepts. And I've been inactive for a week. The reason was my health issues, but I'm back. And before moving on to this one, again, thank you to FT UK for sponsoring this and making it accessible to everyone. FT UK is one of the best platform in the industry, and it's operating from 4 years. Now, let's get into the lesson itself. So in this lesson, we are going to be talking about market maker models, which are called MMXMs as well. We're going to talk about where it's formed as well. And this is the concept that like for the first time I got profitable with. Yeah, so this is something that you should be looking into as well. It's simple, and I'm gonna break it down for you. So market maker models are basically a patterns that appears, and it has like a lot of generated liquidity, and it starts with a consolidation. So if you go back to the previous lesson, we talked about generated liquidity, right? So we're going to be using that there. So market maker model has a consolidation and then generated liquidity, and it's a type of pattern that you will see appear over and over again. Then if we look into where they are formed in the low time frame retracement of high time frame order flow. So remember, if we talked about retracements and high time frame order flow in the previous lesson. If you haven't watched that, you can check it in the description. Link will be given there. So we talked about it, and what I'm just going to quickly recap. We talked that when market is in an uptrend or downtrend, let us assume it's an uptrend, and there is a retracement there. In that retracement, if we zoom in and go to the low time frame, we'll see a bearish order flow, right? So in that bearish order flow, we will see this pattern appear, and then market is going to reverse and then go to the upside. So wait, I think that this might be confusing like that, but let me just go to the schematics. So here's the schematic, and this is how it looks. We have an original consolidation, and then a distribution, a redistribution, and then reversal, and then it starts going back up, accumulation and reaccumulation. Now, whenever I teach market maker models, I know a lot of people get confused over these different terminologies, but you don't really have to remember them. I mean, just say that there's going to be a leg like this, like a consolidation. Then there's going to be like another consolidation, and then it's going to break down, and then it's going to hit a high time frame PDRA where there's going to be reversal, and then after that we are going to see like a kind of consolidation in the upside as well. It will be called accumulation, and then we'll see it another time as well. It will be called reaccumulation. Now, this doesn't necessarily have to be two, it can be just one as well here. Same goes for the accumulation. It can be three as well. Distributions can be three as well. It can be four as well. So there's like no number of that, no specific number of this. But the main thing is that it's going to start with consolidation. So there's going to be liquidity generated here. There's going to be like liquidity generated here, and then it's going to be liquidity generated here. And where is this going to be formed? This, if let's say we are on the 4-hour chart and it is going higher, and then this is the M15 chart. This will be formed when that H4 chart is moving lower for retracement. So this is where that is going to appear. And your best entry is going to be this one. I'm going to get over this later on, but you don't really have to catch this reversal here, because most of the time you will actually confuse reversals for continuations for reversals. It might just go lower again and then hit another PDR, and from there it can reverse. So the best thing to do always is to trade the continuation. Now, if I were to trade this, what I would do is that I would wait for the accumulation. And once this accumulation appears, I'm going to buy from here and target this high. This is how I would trade. I would never trade the reversal. You can, but I won't recommend that. And here's how a bearish market maker sell model looks like, or a market maker, a bearish market maker model. So it's the same thing. It's just different terminologies: accumulation, reaccumulation, and then distribution and redistribution. And this is going to be formed in high time frame bearish order flow, and the pattern is going to appear on the lower time frame there in the retracement phase. And this is what I meant when I say it's going to be formed in the consolidation. Sorry, the retracement. So this is a retracement, right? So if you zoom in there, you will find out a market maker buy model on the lower time frame here. And this is where you are going to find the market maker sell model if you zoom in. Now, we have different time frame alignments for this market maker models. For example, if you are looking at monthly order flow or monthly trend, then you want to go to a daily time frame for looking into market maker models. If you are trading on if you are looking on the weekly chart, then you want to go to the H4 chart for the model. If you are looking at the daily trend, then you want to go to H1, H4 to M15, H1 to M5, and then M15 to M1. So this is necessary. Now, these are also not like, it doesn't really have to be that precise. I mean, if you go to the M15 and then you want to go to the M2 from there, that's totally fine. It's not that big of a deal. Same goes for daily to H2 or H3 as well, weekly to maybe H4, H8 or H12. So it doesn't really have to be that specific. You just have to use your logic there a bit. And now we are going to get into the example. So take a look at this here. We have this uptrend and bullish order flow, right? This is what we call it. and we have price doing a retracement, right? And then it hits an auto block if you look into this. So high time frame PDRA is hit, retracement is made, and now we expect price to go higher from here. So if I zoom in here, take a look at this. It starts with a consolidation, and then it moves lower, hits the auto block, and then from there we get the reversal. Also, what I was talking about here is that once this hit this, take a look at this. It went higher, made a market structure shift, but it didn't really went higher from there. It came back lower, made this new low here, and then went up from there. So that is why I asked you to not trade reversals and rather wait for the accumulation or reaccumulation. So in this case, if I had to enter here, I would have entered here or here and targeted this high here. Here's another example. So we are in a clear downtrend. Price has hit an auto block. This was a retracement, and we are going to go into the low time frame. And you can see the market maker model here. The consolidation is here. Then the smart money reversal, or the whatever the simple reversal you can just call it, our market structure shift. And then a low risk. This LRS means low risk sell, but that just basically is market structure shift. You don't have to get confused over this. And then distribution, and then a redistribution, and you can see price has finally hit the target. Another example here, price is trending to the downside on the daily chart. It went into a daily fair value gap, as you can see. And take a look at this. The consolidation here, it went up. This is the accumulation, and then it hit the daily fair value gap, and from there it got down lower. Now, if you look into this, simply no entry here, but the reason why I have included this is to show you that you always won't get entries. Sometimes you're going to miss the markers, and that is fine. You can just wait for another one to appear. So you don't really have to stress out on missing a trade or something. And here's another example. We are trending to downside. Price has taken out this high here, and we can see a market maker sell model here if we zoom in. And yeah, there it is, consolidation, and then smart money reversal here, our market structure shift here, and then the distribution here. And you see we didn't get a chance for the redistribution, but again, as I said, that's normal and it can happen. So your best chance up entry here would be here, the distribution, and yeah, you would have targeted here. Now let's go into how to catch expansions. There are ways to avoid the consolidation, because apparently no one wants to get into trades that are in consolidations, right? It's just stressing. So I have a way to actually ensure that we are not going to get into consolidation, and it works most of the time. So what you want to do is that you want to have a bias or a drawn liquidity. You want to understand where the market is going. Then you want to wait for price to take out a short-term high or low on a high time frame. So picture this, price is going to the upside on the daily chart. Then there is a daily low or a short-term low here. Market comes lower, retraces there, takes out that short-term low on the daily chart. Now, if you go to the low time frame there, so daily to H1, right? We are going to go to the H1. You will see a reversal pattern there, right? Once that reversal pattern appears, you can anticipate that market is now going to expand to the upside. I don't get into reversals again. I always wait for the accumulation, but just saying that you can do that if you trust it, and you need to have data with you. You need to back test. Okay, always you have to back test. You don't have to rely on my words. So if you back test and it works for you, it works for you. Just trade it. You don't have to take my word for it. So take a look at this schematic here. Price is moving to the downside. We have a drawn liquidity. Price is moving to the upside. We have a drawn liquidity to the upside. Now let's get into the next schematic. And now we have that anticipated red on the short-term low or short-term high. Now what are we going to do? We are going to go into a low time frame here and wait for reversal on both charts. So if you zoom in here, okay, if you zoom in here, you will find something like this, right? Prices has taken out this high, so I assume this is that high, which it has taken. Then you will see a market structure shift, and then that's where the reversal is going to start, and you will see expansions to a downside. It's very simple and effective way to find expansions, and a lot of people don't know about this. Most of the people will just try to sell right here, and what is going to happen is that they're going to get into deep drawdown. But the optimal way that I trade continuation is like this. Actually, I actually used to trade this way. I have a different model now, which works better, and I'm going to explain that as well. Don't worry about that. And yeah, the same goes for when in a bullish case, price has taken out the short-term low, and you can see it here on the low time frame, market structure shift, and you could have bought here and sold back up. Here are the examples. So short-term high is taken out, price is trending lower. So if I go to the low time frame, here we go. Here's the market structure shift, and look at the expansion afterwards. Again, short-term low is taken out, market is trending to the upside. And this is the low time frame chart, and if you look into it, we got a reversal here. The drawn liquidity was met. Same thing goes here as well. Short-term high is rated, market is trending to the downside, and we got the market structure shift here as well, and price then expanded lower. And these are the different entry patterns that I use to enter. So my main entry pattern is going to be the intermediate term high and intermediate term low model, which I talked about. So I enter once an intermediate term high is made. So I have three ways to enter on that. Once the market structure shift happens, then I wait for price to take out a high, which is here. Then I wait for price to move lower, then a bit higher, created this high, and then I wanted to break this low that created this new high. So once that happens, I will enter here, have my stop loss at the intermediate term high, and target my drawn liquidity. The next way that I enter here is again wait for the ITH to form, I mean price to take out a short term high, then wait for all this to happen as well, but we don't enter here. What we do instead is that we wait for price to make a big leg down from there, and then we wait for price to go above the premium, go to the premium above the 50% level. You can do that by drawing a Fibonacci from here to here, and you can enter there, have your stop loss at this high, this new short term high, actually not the ITH, and then target your whatever you want to target. And the next one is that sometimes you won't see market doing this. Actually, you won't see it making this high. It's just going to take out the high, then break lower, and take out this low or high. You can just imagine it the opposite way, and you will understand the bullish models as well. And then you want to draw Fibonacci from here to here and enter on the 50%, above the 50% level. And your stop loss is going to be at ITH. And you can find the examples here. Take a look at this. We have a short-term low red, expansion higher. So I draw a fib from here to here, and you can see this is the 50% line. Price came lower, and then it went higher from here. If you look into this, here to here, we draw another fib, prices came lower, and then expanded higher. So this is actually our third way of entering, if you look into it. And this is our second way of entering. And then we have again a short-term low red, and then price comes down lower to the discount, and then price comes down lower. Sorry, it doesn't come down lower, but the reason why I've included this is that sometimes it's not going to come lower, and you just have to accept that. And so that is the sole reason I've included this. But if you look into this, you got into here. Now take a look at this. And by the way, this works on every single time frame. I'm on the weekly chart right now, and this is Bitcoin. You see price took out a short-term low, then went higher. And if you draw a pip from here to here, you saw price came lower below the 50% and then went back up from there. And if you draw it from here to here as well, you saw price came down lower. The stop loss is still intact and then went higher from here. And here are some more examples. I have executed these. Red on a short-term low, price went higher, and then I couldn't get a chance to enter here. When I opened the charts, it was right here. And then again, we have a short-term low red. Now you might think this is not a short-term low red at all, but this is an SMT, and SMT is basically a short-term low red. SMT is when two correlated pairs have divergence at the low or high. So in this case, this is NQ here. So ES took out this low, but NQ didn't. So this is an SMT. So I consider this a red as well. Price went higher, and then I entered from the auto block here, and then I sold back up there. This is another one. And I want you to pause this and find the logic in here. I will explain it in 2 seconds. Yeah, so if you look into this, we have a structure shift, an ITH formed here, break up this low, so I enter here, have my stop loss here, and then sell some back here, and then sell some back here. So you buy some back here and buy some back here. And here's another example. Again, I want you to pause the video and actually understand it, try to understand it yourself. So I'm going to now explain this market structure shift here, and then a red on this high, then a break lower. So entry is going to be here, stop loss is going to be here. It's not taken out, and then price moves over, take out these lows, and yeah, the trade is done. And again, same thing going on here as well. Red on a high, break lower, and then entry here, and then price just moves over, and I'll buy it back here. Yeah, so this was it for this video, and if you want the PDF file of this, you can check the link in the description below to my Telegram. It's free, you can join there. If you're looking for a prop firm, gonna check out FT UK, and they've got a crazy deal going on right now. You can get a 50K instant funding account for just $498. I will link it below, and you can check it out. Make sure to like, subscribe, and see you in the next one. Goodbye.